We also the key concept and terms, which I call the most important, one of the important things that we need to understand as traders. What's next? Let's try to look at types of orders. You know, I prepared this specifically after pips, leverage, and lot size, followed by this because these are important and it will also help you to understand exactly what you're doing. Types of Forex orders. There are three types of orders. We have market orders. What are market orders? Market orders are executed immediately at the current price. Okay? They are suitable for traders who want to enter a trade quickly. So let me give you an example. If you want to know the type of orders, let's say I give a signal or you're just trading, you see an opportunity where you want to enter. You place a trade buy, bam, immediately it is executed. That is market orders. That is why it's saying market orders are executed immediately at the current market price. Current market price. For instance, let me give you an example. If I say buy British pound right now, you're going to buy at the price where the market is currently. Immediately you enter and you either be in loss or profit, depending on the market fluctuation. So market orders are executed immediately. You go on your MT4 right now, you place a trade, that is a market order. And those are suitable for traders who don't want to wait. And then we have now what we call a limit order. Limit orders are placed at a specific price or better. They are used to buy or sell a currency at the desired price. So limit orders, let me give you an example again. This time, I want us to use cryptocurrency. Let's say BTC USD. Okay, so let's look at BTC USD because it is crucial. Why have I used this? Right now, BTC USD, it is still moving because even these, they trade almost throughout. There are no holidays, no nothing. So right now, BTC USD is fluctuating, or let me just say BTC will go on cryptocurrency. And then let's try to choose any cryptocurrency. I want to demonstrate something. We are going to use that. So what I'm going to do, I want to show you now what we call a limit order. So let's say you see that the market will be dropping based on the market structure, lower low, lower high, lower low, lower high, lower low, lower high. And you think that BTC is going to be dropping. But before it drop, you expect that BTC is going to reach at that level again. So you don't want to sell right here. You want to come and sell at that level. This is where now you have to do what? To put a limit order known as a sell limit. Once the market comes and trigger this level here, immediately it will be triggered. But right now it will remain a pending order without any effect on your account or whatsoever. Unless the market price reaches and trigger that level there, only then will you see some actions and reactions in your account. But in the meantime, you are expecting to say, I don't want to buy immediately at that price of Bitcoin, which is 84,813 currently. But you want to wait for it to reach that 85,517 price. So you're going to put a limit order. Let me try to demonstrate. Let's try to log in. We try to log in. Okay, just that. All right. So again, that is a limit order. Sorry about that. Now, if you also expect that Bitcoin will be buying, but you don't want to buy it, it's too risky for you. You say, okay, I'll wait for Bitcoin. I want to buy Bitcoin when it reaches at this bullish order block there at the price of 79,500. So you're going to put a pending order or a buy limit here, where a buy limit, you say, okay, if the market drops, reaches that level, it will trigger that buy limit. And then if it is start moving up, I'll be making money. Okay, so you use a pending order of a buy stop or a buy limit. And then you also say, you put your stop loss right here below. Assume that is your stop loss. Like that. So the moment the market comes, it will also, the stop loss will protect your account from unnecessary losses, because you already know how much you're willing to lose. And also your analysis is authentic and crystal clear. So there is nothing to worry about. So the moment the market comes here, it will execute this limit order. So that is it about limit orders. Let's proceed again to the next. We also have what we call stop orders. What are stop orders? There is a difference between market order, limit order, and stop order. Stop orders are placed at a specific price level and are triggered when the market reaches that price. They are used to limit losses or lock in profit. So stop orders, again, I'll repeat so that you understand. They are placed at a specific price level and are triggered when the market reaches that price. They are used to limit losses or lock in profit. So stop orders, we also have what we call buy stop and sell stop. Buy stop, let's say many people use this type of orders when they are trading fundamental, especially news. So let's say that is a buy stop, and this here is a sell stop. Now, allow me to illustrate this, please. Sell stop, there is a difference between buy limit and the sell limit. And then this here is buy stop. And then currently the price of the market, let's say, is here. Here. I'll even change to dotted like this. So assume this dotted line is what the market is. So buy stop and sell stop, these are different from limit orders. Limit orders, they require to say, oh, if you see the market that I want to sell, you wait for the market to reach at that price where you put a sell limit, and then the market will trigger and drop. Now, what about buy stop and sell stop? So here is what happens. If the market is here and then it starts pushing going up there, it will trigger the buy stop order. Now, this order is specifically for a buy. So once it is triggered and then the market starts going up there, you'll be in profit because it is a buy stop. But if it triggers and then start dropping, you'll be in loss. So that is why you have to know what you're doing. So let's say the market gets triggered, you put your stop loss, your buy stop order there, and then you even introduce your stop loss below for this buy stop order there. You say, okay, that is my stop loss. So what will happen is that this stop loss is protecting this order. And also sell stop is where if the market starts dropping with an analysis to sell that you have seen, and then you put a sell stop, it means once the market reaches this sell stop order, it will get triggered and you are going to see some real action in your account, either loss or profit depending on your analysis. So the market will continue dropping and you're going to be in profit. And guess what? Now what will happen is that each time the market moves, you lock your profit. Okay? Since your sell stop is here and it got triggered, the market reached down below, you move your stop loss, you lock your profit again, just like that. just like that. You keep moving your stop loss. So you're protecting both the profit that you've made and also your capital. So that is what they meant to say. Stop orders, okay, they are used to limit losses or lock in profit. So that is the difference between limit orders and stop loss orders, as well as market execution. Very, very important. Let's move on. Now, let's try to understand this. I'll also start propounding, especially on this topic, but today I just want to give you an intro because this will take time. I have to take just, if it's 1 week, to explain just that session. So tomorrow we'll be going in details again, because for you beginners, we are having another session tomorrow. So let's talk about basic technical analysis. We have charts. There are different types of charts. We have candlestick charts, we have line charts, and we have bar charts. Okay, these are common chart types used in technical analysis. They provide a visual representation of price movement over time. Let's try to look at these charts, types of charts. Okay, so as you can see, the charts that we are looking at right now, these are candlesticks. They are giving us a visual representation of what is happening on the market. So if you look here, we can see the historical price data that GBP USD is showing us historically. We can see that previously the market dropped. BTC or Bitcoin lost its value from the price here. Let's just take this as example. From the price of $99,442 to the price where it reached this level of $78,400. And currently Bitcoin is at the price of $84,770 or $700. Let's just put it that way. So these candles, these are called candlesticks. Now, let's try to look into more details of other what these candlesticks are. Okay, there are other types of candlesticks. Okay, and each type, they have their own way of how they look, represent, and also wake. So let's try to look at other type of charts. Let's look at line chart. This is another type of charts called line chart. It is different from candlesticks, yet they both serve an important role to the analysis, and each have their own advantages and disadvantages. However, you can see what is happening, but for you and I with technical analysis acumen, using order blocks, supply and demand, and swap zone, it'll be difficult for us to spot where these components of the strategies are. But we'll be able to see that the market is dropping. These are called line charts. We also have another type of indicators. Okay, another type of indicators are also known as bar charts. We have bar charts. We have different charts. So this here is a bar chart. It is different from candlesticks and also from line chart. So this is another type of charts that we have. However, preferably we also have what we call hollow candles. This is how they look. And if you look closely, they look hollow inside, like there is a greenish outside, and then between it looks hollow. Okay, and then if you look here, you see that it is different from the normal candles that we usually use. So now, which one is better? The common one and the famous best, which have been advised, is these candles. You can try to look at them, take a look and see what is there, and also what you can benefit from them. Now, let's try to look at another which is key indicators. Okay, so these indicators are signals that can be used to determine the trend, to give you a signal for when to enter and all that. However, personally, it has been years since I last used an indicator, but for the sake of showing you, I'm gonna show you. So we have moving averages and the relative strength index, also known as RSI, are popular indicators for beginners. They help identify trends and potential buy and sell. Let me show you. So right now we are on trading view, and let's say we want to put an indicator there. So let's try to use RSI, relative strength index. Okay, so I'm gonna add RSI there. Okay, so if I do this, can you people hear me? Okay.
Yeah, we can.
All right. So this is an indicator here, RSI. Okay, this is an indicator here, RSI. And then if we want, we use them. For example, right now where Bitcoin is, the moment it reached this level, many people will use this as a buying zone because there are two levels. We have a 70 level here and we have a 30 level here plus a 50, which is like the middle between the supply and the demand. So if the price reaches beyond the 30, many people will take it as a sign to buy. And if the price reaches the 50 level here, crosses it, it is like a breakout, and then that 50 will no longer be acting as a supply. Okay, it will become a demand. Once it breaks, the market returns, uses this 50 level, and then continues to push. You can also do you can change some settings on these indicators. You can make your inputs where you show everything. The style you can change. So 50 levels, instead of 30 here, you can even say I'm going to add a 0, and here, instead of 70, I'm going to add 100. Look here. So if you even make, okay. So now, guess what I've done here? I've added a 0 because that is the normal price where the market, the number starts, 0, 1, 2, increasing. So here I've also added a 50, 100. So 50 here is going to make the middle, or the 50% of 100. Now, if this, let me not go there. There is what we call chorus theory. The calculations here will also come to work hand in hand just using that. Now, for now, let me not go ahead of this. So this RSI is going to help you. If you see that the market reaches that 100, we call it overbought, which means we have to prepare to sell. If this price reaches 0, oversold, we have to prepare to buy. If the market reaches that 50, it drops. Again, 50, it drops. Immediately, this 50 is acting as a dynamic level of demand. Now, let me show you this strategy. Though it is too early for me to say this. So if you try to use and combine this RSI with a strategy of order blocks and structure, you will see that the market did break this structure here, and there is an order block right there. And the market can start dropping again on Bitcoin. Now, if you use an RSI to combine with the same strategy here, you will discover that the level of the order block where the price is, it is almost at the level of the dynamic demand, 50 level of the RSI. Please pay attention to this one. because those who love using indicators, it can help you. So this 50 is working as a dynamic level. So once the market reaches there, the RSI will also show you. If you look at this end of the RSI, it is showing that it is about to start dropping. So now there is just one red flag when it comes to using indicators. They lag, or they can make you make an early entry. This is why you don't just use them as your sole take of information to determine and make decision on when to buy or sell. You have to combine your indicators with other technical analysis tools, candles, structures, and all that. Okay, hopefully I have made it clear. I'll pass. Now, let's look at another one, patterns. The third one. Recognized chart pattern, such as a head and shoulder or double tops, can provide insights into potential price reversal or continuation. So these patterns like head and shoulder, let's try to also, I will put this on a daily chart, BTC. It is very important. And then let's try to look at the reversal. So right now, the pattern that we have here is this double top or an M. And then the market dropped. At the same time, now look at these guys. At the same time, if you try to combine the daily chart patterns with the order block, like here, there is this order block here, it is going to help you. Look, this order block is responsible for the drop. So when the market went back, immediately there was this bearish order block and started dropping. Plus this chart pattern, double top or an M. An M is a sign that you can sell. Please remember, you don't use this as a source of information and decision making. You have to combine them with other factor of confluence. Again, we have another one also known as head and shoulder. Now, in this case, this is the opposite of head and shoulder. It is known as the inverted head and shoulder. Left shoulder, the head, the right shoulder, and then the market went. Again, within this head and shoulder, for you and I as professional Forex analysts, technical traders, we can see there are also patterns inside this head and shoulder. We can see there are order blocks, there are also ranging market structure and all that. So we can use this to determine what is happening on the market. Okay, it is very, very much important. If you want, you can also use a trend line to mark your RSI and determine. So let me just do this. Here, this white line, the one that I've marked on this RSI, a trend line. So you can see when next you can enter, it can help you. So as the market was moving, it came back, reached here, started pushing. It touched this trend line here. Also, it is the same move here that happened there and also here. And at the same time, if you try to use an order block here, you mark this order block there. There. You have it. So the market came, bounced on this bullish order block. Plus, this trend line only touched this level and this level. Yet the market came, touched the trend line here, plus the bullish order block, plus the inverted head and shoulder. This is going to make you unstoppable and minimize your losses and maximize your profits as a trader, as it is very, very, very much important for you to understand what is happening on the market. So another one, we have other types of patterns. Head and shoulder is the opposite of an inverted head and shoulder. But most common ones that you'll be witnessing on the market are M's and W's. If you see a W, I'm trying to spot a W on the market so that I give you an example. Also, this one is an inverted head and shoulder. this one. And then the market went. Now, please, where is the concept of an invert head and shoulder coming from? Simple. The same principle that says that shoulders cannot be above the head. It is true. And it is recognized in the market or the Forex industry. If you see a head and shoulder, and then you do other analysis and other tools, you add them, just know that the market is not going to continue going down, because this principle is that the head should remain the head, also known as the law of the time here, and the market should go opposite. Just like the shoulders cannot be above the head, the market cannot continue below that movement. That is what it means. Okay, it is very, very much important that you understand that. So here is another head and shoulder for selling the market. Here, left shoulder, the head, right shoulder, just like a human being. The market dropped. Now, where could you have bought here? If it was me, I could have sold from that level there. There. Why? There is that bearish order block, the one that dropped the market for 3 days. 1, 2, 3. So when the market reached back to that peak level, there was already that bearish order block. Plus, the head was always going to remain the lead. So the market obeyed and then started dropping. You could have made some money there. And I'm using a daily time frame. This is a long-term perspective type of a trader where you are trading like an investor. You have been holding for months. So that is it about patterns. Let's proceed. We also have the other important aspect, where as a trader, for you to be successful, apart from you understanding these things, it is crucial that you also develop what we call a trading plan. On top of the trading plan, the one that should take the lead is what we call a trading strategy. A well-defined trading strategy is essential for success. It should outline your entry and exit points, risk management rules, and trading style. Now, let me explain a little bit about this. If you are a trader, you don't have a trading plan, you should question your consistency when it comes to trading. Number one, it should outline your entry and exit. For example, you may be saying, okay, I'm a technical trader. I trade the market maker method, and my trading is based on order flows, order blocks, market structure. And then you see somebody also who is trading breakout. You go there. You are everywhere. You have not specifically outlined the type of a trader, and you haven't documented yet what you use for your entry and exit points. If you trade order blocks, you can say, okay, I'll be entering on order blocks, the ones that are valid, that you are spotted on 1 hour, 4 hour, and daily time frame to solidify your entry. Your exit is going to be on the order block again. So if you enter on a bearish order block, your exit should be on the bullish order block, because that is where the market is going to have challenges to break. Risk management. How much are you going to be willing to risk? Okay, are you going to be risking the 100% of everything that is in your account? Are you going to be risking 50% or 10% or even 0.5% of your capital? It is important. And also your risk to reward ratio. How is it? Is it going to be 1 to 1? 1 to 1, it simply means that you can make profit the same amount of profit, the loss that let's say if you did put a stop loss and you calculated that you are willing to lose $20, and then your take profit is also at the level where you can make $20, that means you're not doing anything. You don't have to equalize the stop loss, the risk and also the profit. There must be that unique difference between how much you're going to risk and how much you're going to make. So if you are risking a $300, at least make 3 times that or 2 times that. So if you say, I've measured my analysis and I can make at least 600 out of this trade, I'll lose 300. That is called 1 to 2 risk reward ratio, 1 to 2, where you can make 2 times how much you can lose. So set some rules. Secondly, how much percentage are you willing? 1% out of your trading capital, 2%, 5%. You have to make sure that you put this in place. Trading style. Are you a day trader, an intraday trader? And also, are you a breakout trader? Are you a news trader who just trade the volatility of the market? It is important. Point number 2, set realistic goals. You don't have to put things that are beyond the reality. Remember, greedy makes people lose even if they are seeing profitable entry trades. Avoid chasing unrealistic profits. Let me give you an example. One thing that I almost forget in the trading plan is that you also should have a target. How much are you going to do you want to be making a day? Which brings us to the realistic goals. Okay, so let's say if you're trading a prop firm and then you have $100,000 account funded, you can say, okay, the realistic goal, I can make either $1,000 or even a $500 to $300 every day. That is enough. Okay, you don't have to be taken by the things that you see on YouTube. Those things aren't even real. Okay, what is real is what is achievable and what you yourself can do, not what you're seeing other people doing. So if you have, let's say, $100 in your account, you can say, I want to be making 10% every day of $100, which is $10. That is achievable. And how much are you going to be losing? You can say, okay, I would rather risk a 5% where you can lose $5. You even open a 0.5 or 0.2 micro lot size on GBP, JPY, GBP USD. Trust me, you can make $10 a day because that is a realistic. Another thing that brings us to goals is how many times do you want to be traded? How many positions a day? So if you trade, you say, okay, I'll be trading in my trading plan. I'm also going to be trading London session. You trade. Are you also going to be trading or include New York session in your trading plan? How many times am I going to be trading? There are people that they have set their trading plan. I'll just be trading New York session. They see something, they go there. Trust me, they have lost countless amount of money just that. You make profit, but you see another trade, you just want to jump in, you lose. Stick to your trading plan. Stick to your goal. Number 3, it is very important, especially for beginners. Practice your trading strategy on a demo account before risking real money. This allows you to test your strategy and gain experience without financial risk. It is important. So at least give yourself time, at least a month or 2, to gain confidence in the strategy. That is something that I encourage when I teach people. To say, if you want to gain confidence in what I'm teaching, whether it is true, works or not, give yourself time. And don't wait, start practicing now, not tomorrow. Common mistakes that beginners make, I've even mentioned some. They are over trading. You have already made the trading plan, but you have reached your goal, you still want to jump in. That is also greedy. And also you want to make more money than than what is real. That is greedy. So over trading occurs when traders enter too many trades, often without proper analysis or risk management. It can lead to significant losses. Emotional trading. Emotional trading is driven by fear, greedy, or impulsive. It can lead to poor decision-making and inconsistency results. Avoid making decisions based on your emotion. Just because you have lost, You want to say, I want to recover my money that I've lost. You enter, again you lose. Again you enter, you lose. If you say, okay, my daily drawdown that I've given myself is 5% of my capital. Once you lose that, don't go back again. Come back tomorrow. You'll see how profitable you're going to be. Lack of discipline. Discipline is crucial for successful trading. Sticking to your trading plan, managing risk, and avoid emotional decisions are essential. Please follow this, as it is very, very much important. Okay, now another thing, tools and platform for beginners. I'm pretty sure we already know we have MT4 and 5. MetaTrader 4 and MetaTrader 5 are popular trading platform offering advanced trading analysis tools and automated trading features. We also have TradingView. TradingView is this, the one that I'm using. This is flexible, offers much flexibility and versatile when it comes to doing your analysis. Unlike on MT4 and MT5, you're going to be limited. But on TradingView, I can adjust. I can do this. By the way, did you know that on TradingView, you can even use a demo? You can link your account. If you have an account with IC Market, Easy Market, Paperstone, Binance, 8Cap, or Paper Trading, this is a demo account that you can use. So I can connect it. Okay, so if you can also download, those of you are just joining us to Forex trading, you can also download your TradingView on your app store or Play Store. Also for your PC, you can do the same. Because if I want, I can enter a trade right here. As you can see, it is using units. So if I say 100,000 units of currency, I'm saying I want to enter one standard lot size. So if I buy there, the trade order has been rejected, not enough funds. Okay, so I have to replenish that. So it is important. Resources, numerous resources online such as Forex website, blogs, and education. Please, it is important to always keep learning. Keep learning, and don't stop. So final thoughts and next steps. Remember, Forex trading is a journey, not a destination. So you have to be patient, learn from your mistakes, and continuously improve your skill. Start with a demo account to practice your trading strategy and gain experience before risking real money. Please, this video, I'm going to post it on YouTube, and I'll share the link in the